All right, everybody, thanks for coming. My name is Gil. I'm one of the owners and the director of sales of the Joe Oz Real Estate Group at EXP. We are here today because we are in a unique environment in the market, and we hear a lot of feedback from our agents and our clients that it's really tough to get an offer accepted on a house. We're focusing on the buy side today, and we're kind of going to go through a backstory to educate people about where we've been, how we got here historically, especially in the last few years with COVID and the impacts on everything that's there. So we brought in two experts to kind of break that down and educate our clients and the market in general. And so we hear these things like the market's crazy, there's 35 offers on a property, so many cash people coming from the city, et cetera, et cetera, et cetera. And I'm gonna wait for it to crash. People getting fatigued and frustrated in the process. And when you understand the market's not really one way or the other. It's objectively just what it is, and it's our job to kind of guide people through that with the information that's available. We have Evan Beach from Equity Prime Mortgage, a preferred lending company. Evan's been in the business for like 15 years, right?
Correct.
14, 15 years, and he was through the financial crisis in 08, 09, and the rising market since 2010, 11, 12, into everything that's been going on, and we've seen firsthand how his professionalism and his company's expertise has been able to keep deals together and put deals together and offer lending solutions to clients who wouldn't otherwise be able to buy a house. So we've got him here to talk about the interest rate side of things and how the mortgage side of things work and what's been happening in the last few years. And we've also got Mark Gilmartin, who's one of the lead agents on our team. Mark has a background in finance through his college education, and then he was actually on the floor of the stock exchange when Lehman Brothers imploded in 2008. It wasn't his fault, but he was there. And then since then has gotten into the local real estate market and become a hyper-local expert at the Jersey Shore. And he's going to be kind of touching on the same points from the agent's point of view and working with an agent and what it takes to actually get an offer accepted and what the agent's role in that is. You guys should follow them on social, that way you can keep in touch or ask some questions afterwards.
Quick shout out to our friends from Last Wave Brewery, Nick and Bert over in Point Pleasant. If anyone hasn't been there, they have an epic brewery. Once it starts warming up, they got a great little outdoor beer garden that we recommend you guys visit. I got the A-Frame IPA. What do you got?
We got the Cross Step Vienna Style Lager.
All right. Shall we?
Yeah, absolutely.
So guys, thanks for coming here today. A lot of what we're going to share with you, some of you guys might already know. Some of you might learn something today. I think nonetheless, just learning this stuff and being able to talk about it, not only is going to help you potentially with your business or if you're trying to buy a house, but just being at a cocktail party, being at a family dinner, understanding all this stuff just kind of makes you a more well-versed person. The first thing we're going to start with is kind of like the historical background with how we got to where we are. And we're going to go as far back as like the 2008 stock market crash and real estate crash. I think we all remember that. We're all old enough to kind of live through that. Some people may have had loans at that time to experience the wild swings we went through. I was actually interning as a junior in college on the stock market, and my last day, the market dropped 1,000 points. It was in late August of 08. And then I went off to school and watched it proceed to drop 15 or 20% in the next 2 months, and the whole economy kind of crashed. So as a finance background, it was really interesting to study that during that time and kind of watch it. The last day I was literally about to fly back to college, I'm seeing the market firsthand on the floor about to crash. So pretty interesting. Evan and I were talking the other day about how that crash is talked about today. People think that this bubble that we're living through right now kind of has similarities to that. And we had talked through how that's not necessarily the case, and that the climate right now is quite different right now than it was in 2008. And a lot of things aren't in place that were then that led to that crash. So right now we're experiencing very high appreciating real estate prices, just like it happened in 2006, 2007, and then it kind of came crashing down. So I don't know if you guys remember, but it took 5, 6, 7 years for a lot of the housing prices to rebound from 2008 all the way back to, say, someone who sold a house in 2008 2008 maybe didn't see the same appreciation until 2014 or 15. So, Evan, I'm going to ask you maybe from your perspective, because you were a lender then as well, what do you see that's so different now from then?
Yeah, absolutely. I'm embarrassed. I thought this was a buyer battle plan on buying crypto. I thought that's what we were getting into here. I thought we were going to talk about Bitcoin and things like that, but I misunderstood, so I apologize. Hopefully I can stammer through this and give you guys some info. No, seriously, yeah, I was in the business in that time frame, started doing mortgages in 2003, 2004. I like to refer to it as the Wild Wild West times, because it was literally like when I first started working at the company I started at, I didn't even know what a mortgage was. And they literally just started putting pieces of paper in front of you, little black box phone, wasn't cordless, had a cord on it and everything like that. It was like the movie Boiler Room, basically. So it was just a refi shop, and it was, hey, Mr. Jones, I see that you're at 8%. How about we take you to 6%? And how about we give you $20,000? Oh yeah, your payment's going down $200. Who's gonna say no to that? Right. So the first year I started doing it, I'm like, this is amazing, this is the easiest job in the world. And as it progressed to 2006, 2007, what was happening, it was so unregulated. I mean, it was legitimately Wild Wild West. You never needed a license. My license was, the manager of my office coming up, here, sign this, and that was it. Yeah. Whereas now, it's not easy to get your mortgage license.
Have you seen the movie The Big Short?
Yes, yeah. Exactly. If you haven't seen The Big Short, that was it. They reference the strippers and stuff that have, don't show any income. She's like, oh, I own 5 houses. That's basically what was going on. And also the other big problem was there was just no lending guidelines whatsoever. I mean, it was legitimately, hey, Mr. Jones, I'm talking to you, sounds like you have a pulse. Here's $500,000. Like, that was the climate then. And couple that with the fact that the appraisals were so ridiculously inflated, and lenders were in contact with the appraisers. Much like it wasn't Gilly's fault in 2008 that the market crashed. It was probably a little bit of my fault that the housing market crashed. Not necessarily my fault directly, but it was just unregulated. So we'd be able to call an appraiser and say, hey, or they would call us and say, hey, look, you're looking for $400,000 on this house. I'm not finding anything more than like $315,000. He's like, what are you doing to me here? And I'd say, oh yeah, just whatever you can do. And without fail, it would come back at 400. So it was just faulty appraisals, zero guidelines as far as lending goes, which led to a massive amount of foreclosures and people that could not afford the homes that they were getting into. In addition to adjustable mortgages, the 228 mortgage was a big thing then, which is a 2-year fix and then it goes adjustable. And the reason people were writing those is because they had lower initial interest rates. But the problem was somebody got to that 2-year period, which again, 2 years isn't that long. Then all of a sudden their rate that was 6% is now 9%, and it's crazy. So that's basically what had happened then. And the reason why, again, we want to dig into that a little bit is because, as you can see here, on the left side here is the 4 years of the housing crash, 2007 to 2010 versus 2018 to roughly today. And you can see the major difference, obviously, is the rate of foreclosures. And that was because of zero guidelines in lending, inflated appraisals. People should not have been lent money to refi the homes or to buy the homes that they were purchasing. So you had people that were just like, what's going on? Somebody gave me this money, I don't know how to pay it back. And that's why you led to this massive amount of foreclosures. Whereas today, guidelines are much more strict. Most people in this room are realtors. How many people have contacted me, what's going on with this pre-approval? Why can't we need this pre-approval? I'm like, guys, we got to get involved with this now. There's guidelines. We have to follow these steps to make sure that people can afford to pay the money back. Somebody that's getting lent hundreds of thousands of dollars, it's the biggest financial transaction in their life. They should be scrutinized and be pre-approved to be lent that money to buy the home or to refi. And that wasn't happening back then. So again, I think I saw this graph and I was like, wow, this is a stark difference because, again, I think, is the next slide that says crash? Is that what it is?
No. Not yet.
Okay.
I think worth mentioning, though, guys, is why things are so different is you got to imagine how many homes were flooding the market with all these foreclosures. So that's a lot of buying opportunities. It wasn't necessarily a seller's market then. There's tons of homes just coming on the market. Buyers at the time had tons of choices. Right now, there's nearly zero foreclosures. So that's a lot of homes that were available after the crash that are not available right now. Evan said something to me the other day that like the people are paying their mortgages. The people that have mortgages are qualified buyers and they're making their mortgage payments. So they're not defaulting.
And also what you'll see too is like 2020, there was a pretty big event in 2020, if anybody remembers it or not, I'm not sure. The worldwide pandemic hit. So what they did was they came out and they put a moratorium on actually foreclosures. So they paused foreclosures. They also did, from a mortgage standpoint, they allowed anybody to go on what's called forbearance. And forbearance is basically putting a pause on your mortgage payments. It's not by any means forgiving mortgage payments, and this was a huge thing in the middle of 2020 when they came out with this. People were thinking, I had people that were not laid off, that were making hundreds of thousands of dollars a year and just went into forbearance for the hell of it because they thought it was a good financial move, because they thought it was forgiveness. And it's not forgiveness, it's pausing your mortgage payment. You're paying $2,000 a month. If you don't pay it for 3 months, you still owe them $6,000. It's just a matter of now they put a pause on it, so they're going to put a second lien or they're going to put it onto the balance of the mortgage. So that was a big portion of this too, is that people that truly needed that forbearance program, that a lot of people in the food and hospitality industry got devastated. I mean, the people weren't working for a year plus. Those are the people that needed that, and even those people then weren't being foreclosed on because of these programs. So that's the other major reason why you'll see during the housing crash of 2008, 2009, it was on the upswing, and from 19 to 21, it's actually gone down rate of foreclosures, which is pretty astonishing considering there was a major financial crisis in 2020 and beginning of 21. So worth noting.
So moving on, we want to talk about today's market. Obviously, it's a hot topic. Everyone's talking about how crazy the market is and the rapid appreciation of homes. Most housing markets have seen close to a 20% increase in a single year, if not more. There's certain areas, Idaho, Florida, certain states you hear about that are like close to 30% in single year home appreciations, which is wild to think about. A lot different climate, and we want to just talk about what has driven that and what is still driving that. It's worth acknowledging there was a historic amount of stimulus that was put into the economy at the beginning of this pandemic. So there was a lot of quote unquote free money that was put out to people. It was mostly forgiven to businesses, mostly forgiven to individuals. We were all stuck at home too. So there was no leisurely spending that could be done. You weren't able to really go on vacation. You weren't going out to dinner. The only thing you were spending money on that was something that could be delivered to your door. So a lot of people ended up having a much higher savings rate through the last couple years than they had historically. It's not the common for America, but it definitely was experienced. The record low interest rates. The interest rates, which we're going to show you in a second, got as low as into the twos.
Yeah.
I was very lucky to be able to refi myself at like 2.89. So the interest rate being that low increases everyone's buying power. So everybody is saving extra money and they're at a low interest rate. So all of a sudden their purchasing power, where they thought they could buy a $400,000 home, they're now looking at a $500,000 or $600,000 home. You couple that with everyone who kind of wanted to leave urban areas. So you had a lot of people living in these one-bedroom apartments and they're being told that they're going to work from home for the unforeseeable future. Why would they want to stay in that one-bedroom apartment in New York City or Philadelphia? So they're going to stay with their parents, or they're trying to find a house where they can have a yard and a pool and all these other amenities. So now these neighborhoods that you and I are living in and we're helping people buy and sell in, everyone is flooding these markets. So there's just a rapid increase in people trying to buy homes. So totally different climate right now than what we had back in 2008 and what was driving that. So there are a lot of people that we talk to that are like, oh, we think that a correction is going to come in the real estate market. And it's really just, we don't really see that happening. So we have a interest rate chart just to show you short term. through COVID. This little virus sign is where COVID kind of hit. It's in March of 20.
Yep.
And you'll see historically the interest rates were just about 5%, dropped down as low as below 3%, around 2.5%, and now they're creeping back up. And I'll let kind of Evan dig into what was driving some of those fluctuations.
Absolutely, yeah, and to kind of piggyback Mark's point too about the rapid appreciation was where I call it kind of the perfect storm, is that, like you mentioned, we had people that were, it was unprecedented demand and unprecedented low interest rates and people having money. I mean, it's as crazy as that sounds, you had the stimulus packages, people that didn't even need money or just have money just automatically deposited into their account. Like I was never busier in my career than I was I was terrified in the beginning of 2020 because nobody knew what the hell was going to go on, but I've never been busier in my career from the middle of 2020 until probably the end of last year, I guess. And things have leveled off a little bit, but I'm a great example. Like all of a sudden there's just an automatic deposit in your bank account. So now we have people that have zero expenses, have money. So over from the, call it March, April of 2020 when all that stuff getting enacted, now they have full 6, 7, 8 months of just saving money. So you hit 2021 and you hit now, people have savings, have down payments, which again, to me, it's like a perfect storm of what we're experiencing as far as historic demand. And anybody that's in this room that's in the business knows there's very low supply. How many people are like hawking the listings on MLS, seeing what's popping up on the market, and have had been to open houses where there's lines around the block, and it's nuts. But so I agree 100% with Mark about that aspect. But to touch on interest rates a little bit, and the reason why it's helpful to have this pulled back kind of chart here, showing from 2018 to where we're at today. And as Mark mentioned, the little green virus in there that's become the symbol of everything now, is where COVID hit and what had happened there. And normally if I drill into that even further, the scariest week was that like middle of March in 2020, where nobody knew what was going on. I mean, the stock market was out of control. Mortgage-backed securities, mortgage rates were just pinballing, literally going up and down a full point every single day. It was just like sitting there watching charts like, I have no idea what to do. People were calling me like, hey, I'm buying this house, so I'm trying to refi. I'm like, okay, I don't know what I can do right now. It was that extreme. So thankfully, and this is probably the only time you'll hear me say this, thankfully the government stepped in and started buying mortgage-backed securities, and that is the reason why mortgage rates basically went down and plateaued and stayed low, as you'll see here, from 20 going down into 20, obviously into 21, and kind of really hit their low towards the beginning of 2021. The other reason we show this too is how interest rates have started to go up at the beginning of this year. It's been an extremely volatile market over the last 2 months, really since New Year's Eve. Rates have gone up a full point in a very short period of time, which again makes my job super fun. But again, we wanted to show you this as a pulled back 4-year stretch, because again, it's funny because I obviously talk to people on a daily basis about interest rates, and people are shocked when I tell them that rates are in the low 4s. Like, oh, that's so high. I'm like, it's so high? Like, in what world is that high? Like, what's your credit card interest rate? What's your personal loan interest rate? What's all of that stuff? I mean, to say that low 4s is high is insane. And again,
for perspective, we have going back as far as 1975 here. This red line is today's rates, just to show you historically. When we're working with buyers, or a buyer thinks, oh man, I just got quoted in the 4s, but my friend bought a house last year and he was at 3.25, they feel like they're getting burned. If you think on a historical perspective, you're not getting burned. I had heard a story how my dad bought a house on Gully Road in Wall Township at an 18% rate, probably somewhere right in this gray range. I can't imagine making an 18% payment on today's housing prices. It'd be insane. But just to give you guys some historical perspective, especially people who are thinking about buying, if you're hearing the rates are moving up, they are not that high from where they could be.
Yeah, I agree 100%. And it's funny, you don't even, again, like ask your parents what their first interest rate was. You don't even have to go back that far. I mean, you can go back to 2010, even 2015, where rates, or obviously we even towards the 2018 range, we were scraping 5%. So historically speaking, rates are still it's still a very good time to borrow money, and obviously the housing market has dictated that. If rates were at 10-12%, would we see the surge that we're seeing of everybody trying to buy homes? Probably not, but so basically we kind of added this in last minute too, because I wanted to show people the volatility of what we deal with in interest rates on a daily basis to really drive home the point of when I talk to people initially, their first question without fail is, what are rates like? What are your rates like? When in reality, rate is just one piece of the equation, and it shouldn't, anybody that's talking about interest rate in this environment, and I'll show you the volatility here, is having the wrong conversations. It should be affordability. It should be payment. What's the payment look like? Because if I tell you that you're, oh yeah, I'm going to get you, Mark got you this offer accepted. Your payment's $2,000 a month. Oh, that's incredible. What's my interest rate? I could tell you your interest rate's 15%. Are you still psyched at the $2,000 payment? Probably. That's how. But people are so brainwashed to think, like Mark mentioned, of having rates that were in the twos. I still get calls. Oh, like I said, rates are 4 1/8, 4 1/4. Oh, that's so high. Really? Okay. Well, go back to that. But the reason the chart shows but basically the point that I have to drive home, and the volatility of that chart shows that we've literally, even this week is a great example, which is why we wanted to pull that up. We've had rates literally go up and down 1/8 to 1/4 since Tuesday. I mean, literally since Monday, Tuesday. And you'll see here. So this is a great example because that line is the new year. And you can see how level, and just so everybody knows too, I'm not going to bore you to death with graphs and charts, but this is what's called a mortgage-backed securities chart, and this is basically the Bible that mortgage lenders will live by. Green is good, red is bad, and so the larger red candles that you're seeing are bad for interest rates. Mortgage-backed securities, think of it like a stock. The higher the stock, the lower the interest rate will be. So you can see how level everything was going to the end of the year, and as soon as we hit New Year's Eve, full downward trajectory with mortgage-backed securities, which means rates went up to the tune of basically a full point as of the beginning of February that you're seeing here. But the reason I show this is that if I talk to somebody on February 7th and we were talking about interest rates, and then I talk to them on February 11th, we're having a different conversation with interest rates. I mean, it may be 1/4, 3/8 of a point different. So again, the major reason I wanted to pull this up is because of the fact that when, especially people that are home shopping, trying to talk about interest rates when you're looking at purchasing a home we're hitting a moving target consistently. Somebody that I talked to today and says, hey, I need to get pre-approved. What are rates like? Having that whole conversation. It may be on a lightning speed scale, they may be able to lock an interest rate 10 days from when I talk to them. That's if any of these wonderful realtors in this room take them out that day, have an offer accepted, get it into attorney review, and get out of attorney review a week down the road, and then we can figure out when the closing date is and figure out a rate locking strategy. So it may be, again, a week to 10 days on super lightning speed of talking to someone. So that's why having conversations about interest rates in this climate, it's never been more volatile than we've seen this year. As you can see, this was basically, this is this week. So as I was saying, going from Tuesday to today, it's just literally was, oh yeah, rates are 1/4 point lower. Nope, next day, sorry, rates are 1/4 point higher. So as you can imagine, my job becomes super fun in these markets, but it's more so just talking about affordability and what payments are going to look like depending upon what people are going to put down and how it's going to be structured. Very important. If a mortgage lender is talking to somebody about interest rates right off the bat, they're doing a disservice to their clients. That's the bottom line, and this shows it. So,
I think one of the cool things that Evan educated me on that we should all learn, and just without going in the weeds too deep, is this, if this is a stock price and the stock dropping means interest rates are going up, the Fed stopped buying mortgage-backed securities
Correct.
during that time frame. So if it's a talking point for you guys to have with your clients, or if it's clients watching this video, if you're wondering what's going on, what's driving that interest rate hike.
Great point. It's not, and I have people that come to me all the time. I heard the Fed raised the rates. They did a 1/4 point hike, or they did a 1/2 point hike. The Fed funds rate has zero to do with mortgage rates. Zero. So them saying that, in fact, I wish that it was correlated by them saying, hey, we're raising rates a 1/4. Super. I don't have to deal with this. I'll keep it PG. I don't have to deal with this stuff if it was that easy. So it has nothing to do with the Fed's fund rate. It's more so the government stopped buying mortgage-backed securities that they were buying for the last year and a half. And then you couple that with inflation issues, and anybody that's gone to get gas or buy anything right now, inflation's a big problem, and inflation rates are huge, which is bad for interest rates. So you're absolutely great point.
All right, so we're going to kind of transition into more of like a scenario type discussion. We're all working with buyers. There's buyers that are looking at homes and just running scenarios to their head. So we took a pretty typical scenario: $450,000 house listed in Wall Township. We have a purchase price. The listing price is $450,000. For anybody watching right now, you're seeing homes that are rarely selling for list price. I'd say on average, we're seeing prices go anywhere from 6 to 12% above asking. If someone came to me today and I thought that house was priced pretty fairly and they were in love with this house, I am trying to talk them through a scenario of 10 to 12% above asking. Any of the agents in this room, we've had this discussion before. We compare, all these offers that we're either winning or losing to see how far above we were. And if you really want to be competitive, it's 10 to 12%, but it's kind of, it depends on the pricing of the house. So we took a scenario of $450,000 house in Wall Township. We're talking about a purchase price of $500,000. If you're not really considering a purchase price of $500,000 on a $450,000 house, you're probably really not serious about buying this house. Before I even get into the numbers here, if your max purchase price is $500,000, you should not be looking at houses that are listed at $500,000. You should realistically be looking at houses that are probably $400,000, at most $450,000. You got to run the numbers on what 10 or 12% above list price is and figure out what your price point is. That's a hard discussion to have with people that think they can afford a $500,000 house because they were pre-approved for it. They realistically should be looking probably $100,000 lower, or they're not doing themselves a service or being serious in the market. So we have a couple scenarios here. $500,000 as a purchase price, 20% down, which definitely helps kind of make your offer look stronger. These are kind of real numbers. We're looking at a $9,000 tax in Wall Township, $1,800 in property insurance at a rate of 3.25. That monthly payment, which is the discussion that your client should really be looking at in terms of like what are they making versus what their payment is, would be $2,640. We take that exact same scenario that you would have been having maybe 3 months ago,
December,
at 3.25, and we're now talking today at 4.25. The only difference on this middle scenario is the rate jumped an entire point. It took the monthly payment up about $220, which is pretty significant. So the third scenario, which I think is probably the most interesting to want to look at, only difference here is we're now at a $520,000 purchase price. So your client said, hey, this is the house. I need to win this one. You're going to tell them, consider another $20,000 in maybe. You run the numbers on it, and it looks like a $78 difference on their monthly payment at the same interest rate. So they can borrow $20,000 more for their down payment or for their offer, and it's only going to cost them $78 a month. That's a discussion that buyers should be having with their agents. When they're seeing $20,000, they're thinking that's a ton of money. when you're considering it and financing it and you're looking at $7, $8 a month, that's one dinner out, if even. I don't know where you're going. Maybe you're going to Mogo Tacos with your wife. That's $7, $8 maybe after half a dozen tacos. The interest rate is probably the bigger jump in interest rate is going to affect your payment more. I mean, you think about a full point in interest rate jumps was 200 points. $20,000 in an offer price is only $78. So these are things that you kind of want to consider, and Evan can shed some light on these discussions that he has with people when they're freaking out about like, oh my God, I'm going to offer another $20,000. In their head, it's a ton of money, because it is. When you draw it out across 30 years, it's $78 a month. So when you're having these tough discussions with your buyers, these scenarios should be played through to show them like how insignificant that monthly difference is.
Yeah, and those are things that I'll have with people and clients that I'm talking to in the first conversation, because you have to. I'm very education based when I'm talking to any of my clients, and even people that I'm just getting on the meeting or getting on the phone with, because they have to understand this isn't HGTV. It's not like, oh yeah, we got the place was being offered at 500 and we ended up settling at 425. It's the complete polar opposite market right now, and people need to wrap their head around that. Like Mark mentioned, like if it's priced properly, again, there's people throwing homes on the markets Hail Mary, and that throws it out of whack. But if it's priced properly, it's going to go for above list price. So you hit the nail on the head, and I have to educate them with that as well. But the kind of flip side of like I don't know what would the opposite of buyer's remorse be? Not purchase from, yeah, like yeah. Miss the boat. But I can't tell you how many people over the last year and a half have like this situation Mark just mentioned. We're like, oh, it went for $5,000 more than we had to stop it. We were at 500, that was our limit, and it sold for 505 or 510. And I'm sitting there, I'm like, you realize that's $20. I mean, they're like, what do you mean? Oh, well, look at this scenario. I mean, even another $20,000 is $78 a month. Like Mark mentioned, you have to put it in real life scenarios for them where it's like it's a dinner. I mean, like, okay, you don't go out to dinner that 1 month to buy this home that is potentially your forever home. And so you have to put it in context and make it real for them, because, again, $20,000 is a lot of money, and it definitely is. But in the grand scheme of things, you're talking about purchasing a home, So I think it's very important for people to understand that. And those are conversations that I'll have with people up front, so they're educated properly for this market.
Yeah, I think one of the things that we want to go talk about is just working with the right lender as well. These buyers need to have these discussions with the lender. If they're working with a lender that they've made a connection with online, and there's really little human element, there's no phone calls, maybe let's say like a Rocket Mortgage or something, and they're just putting in their financials on a website and hitting submit, and they're getting a pre-approval or a pre-qualification. When it comes down to an offer, that offer is not going to get taken serious. Not only that, is how are you going to get a person on the phone like Evan that's going to talk them through these scenarios that, hey, you want to talk them into putting an extra $20,000, which is what you think will get that offer accepted. Good luck trying to find that person at Rocket Mortgage to get on the phone with you on a Sunday at 6 o'clock when best and finals at 8. It's not going to happen. So we just wanted to talk about, like, you got to be willing to work with the right lender. And part of that, when we're structuring these offers is, and I know everyone in this room does this, is you put the lender's contact information out there in the email or in the offer. You call in your offer and you let them know, hey, our lender is available to talk to you. I know you want to make sure that the person's financing is rock solid. Again, Evan's going to do that. He's going to hop on the phone with you at 9 o'clock on a Tuesday. I don't know if someone at Wells Fargo or Bank of America, or definitely not Rocket Mortgage, is going to make themselves available at these obscure hours when your buyer is available to do this and you're scrambling to get this offer in because the house is going to go under contract in record time. It's really important to work with the right lender. Part of that is just going through the right steps, not just the infancy stages to get that pre-qual letter that you can throw in with an offer, because quite frankly, it's not going to get taken serious by a listing agent. These agents are getting 25, 30 offers to comb through. Someone is going to come in with a real lender that they can talk to so they can verify that the person's finances are legit. So We have a little chart here that kind of differentiates what difference of a pre-qual versus a pre-approval is. A pre-approval takes a little longer, and I'll let Evan go into detail about that. It's going to take you pulling out more of your tax statements, your bank statements, your paychecks, all that stuff, but it's worth it because when you find that house, if you're not ready to pull these statements out or you haven't done it already, the house is going to be gone. Somebody already has. If you're not ready to buy this house when it comes on the market, you're not going to buy it. So when you see days on market for some of these homes is 7 or 10, you have to have gone through these steps already, so when it comes on, you have yourself a chance. And you can't be frustrated when that house goes and you weren't ready, because some people are. So I'll let you kind of dig into just how EPM approaches it.
Yeah, absolutely. And when Mark and Gil asked me to, hey, we're going to do a thing about pre-quals versus pre-approvals, I kind of chuckled a little bit because pre-qualification letters anymore are non-existent in this market. Anybody that says, oh yeah, I talked to my bank or I talked to my lender, I'm fine, I should be good, blah, 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 is not going to get an offer accepted because you have to have something, like Mark mentioned, it's got to be so rock solid. And everybody, I get asked the question every now and then, like, hey, what's the difference between a pre-qualification and a pre-approval? Difference is that, yeah, they'll both provide letters. Pre-qualification is quick and dirty. It's, typically there may not be credit even pulled, not going to verify income. It's just somebody on the phone with XYZ Bank saying, hey, yeah, I make 80 grand a year, and them writing it down and doing a debt to income calculation on the back of an envelope, and then saying, okay, well, what assets are you putting down? What's your down payment look like? Oh, I got 100 grand in the bank. I'm going to put 30% down. Okay, cool. Do you know what your credit scores may be? Yeah, I got Credit Karma. My scores are 800. Credit Karma told me. That's a pre-qualification. And then they're sending, oh yeah, here's a pre-qualification letter. That's what a pre-qualification looks like.
And what happens real quick before we go to pre-approval, you get an offer accepted. If you're a listing agent that doesn't do your due diligence and you accept an offer with a pre-qual, now you're 2 weeks into this deal and this person can't get approved for a mortgage. You have to go back to the market. That's the reason a listing agent doesn't want to see that. They want to get to that stage and know that this person's getting approved for a mortgage. And if they're going to verify all these assets, income, and credit score before then they know that hard work that the buyer has to do to prove themselves has already been done.
Right. And yeah, versus, basically what we do, and I love Gil's graphics here too. Like, your agent lender is a clown, and what the listing agent sees is a pile of what, and it's 100% dead on. I mean, that's what it is. Versus what we do, and I'll dive into that a little bit in a minute here, but working with somebody that knows what they're doing and having a fully underwritten pre-approval and goes through these steps and verifies everything correctly, which again, it always astonishes me how people are like, oh yeah, I'm good, I'm this, I'm that. Oh no, you don't need to see that, I'm good, I'm like, hey, Mr. Smith, if you were gonna lend me $400,000, what would you want to see? I mean, you have to level with people like that. Like, it's a big deal. It's the biggest financial transaction you typically make in your life. But Mark's exactly right. And a great point now is offers that get accepted that I've provided pre-approval letters for over the last probably 3 or 4 months. You know how many times listing agents haven't called me? 0. I talk to every single listing agent because they want to know, like Mark said, that the buyer's qualified, that they're serious, where they stand, what the deal is. And once I get on the phone with a listing agent, I'm able to basically go to bat for the client and say, yeah, Mr. and Mrs. Smith, they're so rock solid. Here's why. We have great income. They've both been at their jobs for 7 years. They're W-2 employees, no issues there. Assets, they have money in the bank. We have it verified. We have bank statements. We have proof of funds. We have their credit pulled, obviously, which amazes me that somebody doesn't have credit pulled to provide a pre-qualification letter. Because it's not just credit scores, it's what's on the credit report as well, which determines the debt to income ratio. So I can then go to bat for the client, say, the only reason this deal wouldn't get to the closing table is if something catastrophic happens, like Mr. Smith loses his job or something along those lines that we can't control. So I don't know what my batting average is exactly, but most of the time when I talk to listing agents, it means that they're entertaining the offer. Again, put a disclaimer here, if any of your clients goes and offers 50 grand under list, that listing agent's not calling me, regardless how strong the pre-approval letter is. But it means they're entertaining the offer, and then they know that the pre-approval isn't going to be the determinant of them accepting the offer or not. It's going to be strictly then what the monetary offer is and what the contingencies of the offer is. So super important. I mean, pre-approvals have never been more important in the history of home financing than they are right now, for sure. So
yeah, I think it's worth all you guys asking your buyers that, hey, if an offer was accepted, is your mortgage lender available right now to take a phone call? And if their answer is no, or they're not sure, then they're not working with the right person. And if a buyer isn't sure, then they should be introduced to Evan, because we all know Evan will take a call on a Sunday or on a weekday. And that's the differentiating factor sometimes to ensure the listing agent that the financials are rock solid for that buyer. So next topic we're going to move into, which is something probably you hear with every house right now, is appraisals. As the homes are rapidly appreciating, the appraisals are kind of lagging to catch up. And we're in a market that's been appreciating now for several years, so we are seeing the home appraisals slowly start to catch up. But I can remember, a year and a half ago, it seemed like almost every deal the appraisal was short, and it's a big deal. These aren't faulty appraisals like we were talking about in 2008, where they were trying to shoe the deal in. It's the opposite, actually. They're saying, hey, this house is actually worth $700,000, not $800,000, which you're trying to buy it for. So that creates a unique scenario and a challenge for buyers that need to get over that hurdle. So we're going to go back to that same scenario in Wall Township that we just talked about. The house was offered at $450,000. There was asking price was $450,000. The client offered $500,000. The appraisal came in at $475,000. So there's a $25,000 shortfall in the appraisal from what the accepted price was. Historically speaking, there used to be a couple scenarios. A buyer would actually sometimes negotiate with the seller, where the seller would actually lower their price to meet that appraisal number. In a buyer's market, that was commonly happening. That's clearly not happening right now. Sometimes they'd meet in the middle. So maybe it was, $480,000, $250,000 or something like that, where they would split it. That's not happening right now either. Sellers are in the driver's seat. They have 25 backup offers. They do not need to lower their price to work with somebody who got a low appraisal. So here's a buyer that really wants this house and they're $25,000 short. Here's two scenarios that we can kind of run you through that are pretty common. You're going to come out of pocket $25,000 to cover that shortfall in the appraisal. You maintain your 20% down. You don't have to add mortgage insurance to your policy, and your monthly payment remains the same. I don't know about you guys, but a lot of the buyers that we're seeing might not just have an extra $25,000 laying around to do that. So that's a challenge. Scenario one is not your common scenario that you're seeing right now. So what do you do then? This person really wants this house. You're trying to work with them. For one, you're definitely getting the mortgage rep on the phone, because he's going to be able to speak to this even better than any agent can. But you're going to potentially scale back your down payment. And I'm going to let Evan get into this, because it's pretty technical even for me to speak about. But you scale back your down payment, and I'll let you get into this, because you definitely talk to it better than I do.
Absolutely, yeah. So this is a conversation that I have with every single person that I talk to that's getting pre-approved now, because it's a very, very common thing. I'm not going to ask you to raise your hands and stuff, but I know every single agent that's putting in offers is waiving home inspections or waiving appraisals to some aspect. Every single offer that's going in, if you want to have it accepted, you're going to have to budge on a few of those things to an extent. Again, waiving home inspections is psycho in my opinion. But maybe you waive home inspections to, hey, we only can come back to you with structural issues or things like that. Same thing with waiving appraisals. Now, people come to me, I waived my appraisal, it's good, I don't need an appraisal. I'm like, time out. That's not what that means. It means you're waiving your right to go back to the seller if the property under appraises. Like in this certain situation, the sales price is $500, it comes back, the appraisal's at $475. Like Mark mentioned, a year and a half ago, you go back to the seller and say, hey, we're 25 grand short here. I want to buy for $475, that's what it's worth, here's the appraisal. And there'd be back and forth, and maybe they meet in the middle, or believe it or not, sellers used to actually bring sales prices down to that. That's not the case now. Sellers want to know going into these transactions that you're going to buy the place no matter what. And that's what the waiving of the appraisals does is, again, I recommend, it's really tough to say, hey, I'm going to waive an appraisal completely. But maybe in this circumstance, this client waived the appraisal up to 30 grand or up to 25 grand. So what that does is it, at least if the appraisal comes in 50 grand or 75 grand light, you're protected in some aspect, but I'll leave that up to you guys as far as in this market, it's like, hey, whatever the hell gets the offer accepted is what we're gonna do. But in this scenario, and again, this is something I educate people with in the initial conversations as even before they're putting in offers, because this is such a common thing now, it's gonna happen. And if you don't plan for it, if I didn't plan for this and talk to my clients about it, I'm doing them a disservice, because it's gonna happen. In a rapidly appreciating market like we're in right now, this is an extremely common thing. So people aren't educated to this. So they have scenario one, like Mark mentioned, if there's a gap of 25 grand, we as the lender are only gonna lend on the appraised value, which is 475 in this circumstance. So we have a $25,000 gap. They can say, oh yeah, here's a check for 25 grand. And again, it's not gonna be exactly 25 grand. It'll be a little bit less than that. But, or a lot of people don't understand this, in this particular scenario, again, this person's putting down 20%. So let me throw a caveat in here. Somebody that's putting down 3% or 5%, this isn't for them. They're gonna have a very difficult time.
They're dead in the water.
Buying in this market.
Yeah.
However, somebody that's putting down more than 5%, somebody that's putting down 10% or more, can fall into scenario two here. And this is very simply, and the reason why that we did this math this way is 5% of 500 grand is 25,000. So basically what they'd be doing in the scenario is, instead of putting down 20%, they're now putting down 15%, and they're gonna have a little bit of mortgage insurance. When I say a little bit of mortgage insurance, I'm talking about like $35 a month. So what it does is it gives the seller the warm and fuzzies of, oh yeah, if it does under appraise, we got an out here. They're not gonna pull the plug and do some weird crap like buyers can do in New Jersey. Buyers have a lot of rights in New Jersey. They're not gonna do that because they already have a safety net of going down the scenario number two. So a lot of times, like it happened with us. Jill and I had this happen. Again, to speak to Mark's point, it was like 9:30 on the night, 9:30 at night on the phone with a listing agent. It was somebody that was putting down, I think 10% or something like that. And we could, if it did under appraise, he can go back and scale back and go from 10% to 5%. And it's just gonna add in a 20. Okay, you're right. She was 20. So if it does happen, we can scale back and put down less than 20%. And all they're doing is, and again, people have this stigma of, I don't want to pay mortgage insurance. I'm putting down 20%. I don't want to pay it. That's ridiculous. It's ridiculous. What's ridiculous about it? Would you rather come out of pocket for 25 grand or pay 35 bucks a month, 40 bucks a month? I don't know about you, but show me anywhere you can get 20, 25 grand for 35, 40 bucks a month. I'll be waiting here for a long time before somebody comes to me with that deal. But it's basically a safety net for them to still move along with the offer, and also obviously get the offer accepted, number one. That's the biggest thing in this market. Or if they really wanted to, they can do what's called an upfront mortgage insurance policy, which basically you're charging a premium at closing. So for instance, let's say it's $2,000. They're gonna pay $2,000 additional at closing, and they're not gonna have the 30, 40 bucks a month, whatever it is. So that's an option as well. So again, educating people is paramount in this market, because a lot of people have no idea what this is even an option. People are just scared to death of, I'm gonna waive this and I'm gonna owe this, I'm not comfortable with that, blah, blah, blah. But when it's laid out like this, okay, sure, I don't have to come out of pocket anymore and my payment's gonna go up a little bit. Awesome, okay, cool. Go throw in the offer, let's get it going. It's all about educating people in this market and having a contingency plan if and when this stuff happens, because it's very, very common. Everybody in this room has dealt with appraisal shortages, I'm sure, in some fashion. whether it be 100 grand or whether it be 25 grand. So
I feel like years ago it used to be inspections that would often blow up a deal. If a deal was to fall apart, it would be for a home inspection. In today's market, it's the appraisal. I feel like every single deal we hear about is the appraisal. So if you're not having that, you have to have that discussion basically before you put the offer in, and you have to have a plan for what happens when an appraisal is short. So for buyers agents, for buyers out there, like that is something you definitely need to consider before you're even writing the offer up, is what is the plan for the low appraisal and how are we going to present that to the listing agent so they know that we've already thought through that hurdle and we're ready just to get right over it. So the last topic we're going to go into is just everything you can kind of armor yourself with to craft an offer that'll get accepted. There's so many people bidding on so few homes right now that you have to basically throw everything at it to be prepared to get your offer accepted. So the first one we're going to talk about is just speed and conviction. The days on market, we're all seeing these graphs right now, is just plummeting. A house basically is coming soon, sometimes 7, 10, 14 days out. There might be offers even before it lists. It lists on a Tuesday, best and finals on a Sunday, and it's under contract by Tuesday, Wednesday the following week. So the days on market is historically low. If your person is not ready to see the house within the first 3 days, you need to go there and video chat with them, or you need to just be honest with them that they're probably going to miss out. If they're on vacation, they can't see the house, and they don't want to video chat with you, that house is not for them. You have to get inside that door within the first 3 to 5 days, ideally in the first 1 to 3 days, or you're probably not giving yourself a chance to buy that house. The offer price is obviously the most important point that the seller is going to look at, is like, what will they walk away from? We'd mentioned 6 to 12%, and again, if it's a buyer that I'm working with and they tell me this is the house they're in love with, this is their forever house, I'm honestly saying let's run the numbers, probably closer to 12% above asking. See how that sits with them, see if that's within their threshold of their buying power. What we're seeing is houses 6 to 12%, and again, if you really want to see this person buy this house, you should be pulling them to the higher end of that of 10 to 12%. There are exceptions, these outlier prices where people are just listing their house, not caring if they sell it, and it's $100,000 above what it's worth. You have to kind of make sure that the housing price is fair, but the down payment, can't stress that enough. These people that are 3% down, unfortunately aren't buying houses in today's market. It's unfortunate, but it's just, if you're coming at it with an FHA loan or you're 5% down, you're showing the seller you don't have a lot of wiggle room, for one, when the appraisal comes in short, which is something we just talked about. So you want to try and have that conversation with buyers that the down payment's something that sellers take super serious. It's skin in the game. So part of that too is kind of comes through the payments you can make. So there's an initial deposit, and then your second deposit. Years ago when I got into the business, the initial deposit I thought was often overlooked, and people just said, oh, it's not worth it, it's just a check that kind of bounces back and forth. I've actually seen that change a lot recently, where now it's like immediate skin in the game that a buyer is willing to show a seller, that actually catches some sellers' eyes. Like, hey, this guy's willing to put $50,000 down. He's going to write that check next week if I accept his offer. Years ago, it was like, oh, it's just the additional deposit is where some of that would come in. So another scenario you can talk through when drafting up your offer. We obviously hammered home how awesome Evan is and how he should be the lender that every one of our clients are working with. I'm on the phone with this guy like multiple days a week, and he doesn't need to take my call, sometimes just to like learn about interest rates. So this guy's going to get on the phone with your clients, he's going to get on the phone with your listing agent. Wells Fargo people, Rocket Mortgage, they're probably not going to do that. So if a listing agent can't talk to a human and feel confident that that buyer is ready to get to the finish line, then your buyer's probably not in the best situation. So make sure that they're working with a lender like Evan who's willing to do that.
If I could jump in on that really quickly, because I kind of glossed over exactly what we would do from a pre-approval standpoint. Again, we do a fully underwritten pre-approval, so it's paramount in this market, extremely important. So when somebody gets referred over to me, initial conversations, if I'm not on the phone with a person educating them about everything we're talking about here, I look at my phone or I look at my desk phone, and if I'm not on the phone with them for 45 minutes in an initial phone call, something's missing. Like, they should have these questions, they should be concerned about all of this. But doing a fully underwritten pre-approval is extremely important in this market because we want to figure out, again, to drive that home is not only what they can afford, but what they want to afford. So I can come back to somebody after we've done a pre-approval and say, hey, yeah, Mr. and Mrs. Jones, you should be excited. I got you pre-approved for a $2 million mortgage. I go through the payment on a $2 million mortgage and their heads are popping off their shoulders. So we want to drill in what their goals are and what their caps are. It's very important in this. So it's all very education based from that. And that's really where the point that we come from for that. So again, pre-approvals are huge. So send people over and I'll talk to them.
Have them talk to Evan. He's great at talking to people. The next one's inspections. Like I said, it used to be the topic that would be the real hurdle for deals. It's still taken seriously. I'd say every house I see, I just treat it as an as-is sale, because these sellers really aren't considering any concessions. So when you're talking to buyers, or if you're a buyer watching this, you got to come at this deal thinking that like you're not going to get any money back when a home inspection done. It's being done for your due diligence, one, to learn about the house, learn where the water main is, learn about your electrical panel, that if you buy the house, let the home inspector educate you, and that's what you're paying for. You're probably not going to take what he finds and try and negotiate back on it. You can come at maybe a structural and environmental aspect, like, hey, we're just going to do inspections for structural and environmental, but quite honestly, when they have so many backup offers, they're probably not even going to entertain that. So it's a conversation that you want to have with your buyers, and I know that buyers kind of know this, but if they're coming in, they're going to complain about chip paint and wallpaper and stuff like that. Like it's not going to hold up, and they're going to move on to the next buyer. So the appraisal one, we obviously went into the preparedness to navigate it, just having a plan before you even draft the offer. You should be talking about, hey, can you waive appraisals entirely? Do you have proof of funds? Do you have $100,000 in the bank account that we can show them as a proof of funds that you're ready to hurdle a low appraisal? If you don't, can you get $50,000 below a low appraisal? In the provisions aspect of these offers, you can write in, hey, we're waiving our appraisal contingency up to $450,000 or $425,000, and if a listing agent understands that there's no way this house is going to appraise below that, then you're basically waiving the appraisal contingency, especially if you're throwing in a proof of funds that shows that. So flexible closing date is something that's pretty big. Homes are selling super fast, and I honestly think that some people are not as prepared to sell their house as they think they are. They put their house on the market, it's under contract, and bam, the buyer's ready to move in like 20 days. The seller's probably not ready to move that quick. So if you have the ability to show that your buyer can be flexible, either with a rent back option. I know Sam's working through one of those right now with Sarah, who I saw over at Cafe Vallon just like 2 hours ago. Yeah. Sam sold a house in Point Pleasant, and she's working through a rent back scenario right now. She's been there for what, 6 weeks, 2 months?
Yeah, 6 months.
6 months. So she sold her house. She got paid at these awesome price points right now, and she's still renting it because the buyer was so desperate to eventually own this house that they negotiated a rent back scenario where they can stay in this house for 6 months while they find their next house. And they're having problems finding that house, and people are going to. So that's a scenario that if your buyer is willing to wait, makes it a very attractive offer to the seller who doesn't know where they're going. So many sellers are like, oh my God, my house is worth $850, I want to sell it. They don't know where to go. They can get that $850, and if your buyer's willing to give them time, that's super attractive. To the tune of like, maybe it's a $15,000 lower offer, but you're going to give them 6 months to find that next house. That might be something that really stands out in your offer compared to just the highest price point. The personal letter, some agents won't accept it, and I've actually seen, I'd say the last 3 offers I've put in explicitly says in the agent notes, will not accept it, and is just going to accept an offer based on objective terms. I think if they will let you write a personal letter, you write a personal letter. You pull their dog, their girlfriend, their mom, whoever into a picture, and you write the best letter for them, or they write the letter for you. I honestly half the time write it for them, and I just ask for like the best photo they can find. It depends on the seller. Some sellers go for it. Some sellers don't even want to see it and don't want to be swayed by that, that loving side of somebody who's just trying to buy the house. But I think it's worth writing if the seller will let you and the agent doesn't say you can't. A donation, this is really getting desperate, but sometimes you can reach out and say, hey, we'll make a donation at the seller's choice in the name of the seller. We'll plant a tree somewhere for the seller. Like, this is where you're really just like going for it. But I've seen it. It happens. There's some desperate people out there, but these are all things that you can kind of arm yourself with to throw in with your offer to get it taken serious. Am I forgetting anything there that you're seeing, or that from your side of the lending aspect of it?
No, I think it's just the point is buyers have to be ready.
Yeah.
I think the number one thing there is speed and conviction. I mean, people learn as they go. It doesn't matter how much Mark drills it into them or I drill it into them. People are going to lose offers, and then they're going to realize, oh crap, you were right. What do I do? And they have to be ready. I mean, I have people that are doing virtual tours of properties that they're not near, and I had an offer accepted last week, a virtual tour of property in like Atlantic City area. Never walked through it, had an offer accepted. Like, that's what people are doing. So they got to be ready. I mean, that's the number one thing, is they have to understand what's going into the offer, be educated on the offer, and know and have contingencies and workarounds for things that are going to happen in the process. And if they're not educated on it, they're going to have a very rough go of it.
Yeah.
And having a great buyer's agent is huge in this market. Huge. Second to having a really good lender.
There's a lot of buyer fatigue out there. I mean, I've heard a lot of numbers. Gil, we've heard anywhere from 5 to 20 offers that people are putting in on average until they land one. What Zillow's given us data, what are we?
It's like 20 on average, and that's why you work with somebody, you've got a team behind you, you can get it in 3 or 5.
20 offers sometimes before people land one, which is crazy that they have to go through this whole process 20 times till they might accept one. You can understand why they have fatigue and they're considering renting now. You have to work with somebody who knows what's going on, doesn't think it's crazy, and just thinks it's objective and understands what you have to do to get through these hurdles. If you do, and you're talking to the right lender and you have the right battle plan, you can get your offer accepted. People are buying houses right now.
Yeah, I think having the right team in place is huge. You know, obviously from a good agent, a good lender, and everybody else that we can refer along the process, be that attorney, title company, can't really refer appraisals anymore, but home inspectors, things of that nature are huge. And I have that conversation with sellers agents too. Is like, hey, we got a team in place. This thing is going to be clockwork. We're not going to have any issues closing this. Boom, boom, boom. Here's why. And that goes a long way. So this is not a market for inexperienced people. So I call it this market is the great kind of consolidation. There's a lot of people that got into the business last year, the year before, from a lending standpoint, from a real estate standpoint. It's a different market now.
Yeah.
Way different. So
thanks for sitting through us, guys. Both of us are talking about this all the time. Everyone on the Joe Oz group is kind of analyzing the data. We talk about the deals that we're winning, the deals that we're losing, we're learning, and we're prepared to kind of take people from start to finish to buy homes right now. If your real estate agent isn't talking about these things with you and isn't trying to give you the armor you need to kind of go to battle to win an offer right now, then you might not be working with the right person. If your lender isn't ready to hop on a call with you any day of the week and talk to you about, the appraisal contingency or what happens in the shortfall of appraisal and you're going to change your down payment, then you might not be working with the right lender. You need to be working with somebody
within reason.
Within reason. Yeah.
I don't want calls like 1 a.m. from sellers and stuff. But yes, yeah, I agree.